Vietnam's economy has been growing at breakneck speed, and projections show it could soon reshape the economic hierarchy of Southeast Asia. According to recent forecasts from the International Monetary Fund, IMF, Vietnam is expected to surpass Thailand by around 2028 to 2029 to become the third largest economy in Southeast Asia. Another separate study published by the Center for Economics and Business Research, CEBR, they are not only going to surpass Thailand, but are going to surpass them by a lot. This is a remarkable turnaround for a country that just a few decades ago was one of Asia's poorest. So, what are the factors that are going to drive Vietnam's growth in the coming decade? Well, let's dive deep into the data first. Vietnam's economy has expanded at an average real growth rate of about 6 to 7% per year over the past 30 years, transforming the country from post-war poverty into a manufacturing powerhouse. Even amid global headwinds, Vietnam has sustained robust growth, 8.0% in 2022, with moderate inflation, approximately 3.4% in 2023. This strong performance is set to continue. The IMF projects Vietnam's real GDP to grow approximately 5.3% annually over the next 5 years, and CEBR forecasts roughly 6.7% annual growth from 2024 to 2028, and 6.4% annually in the 2029 to 2037 period, outpacing most of its neighbors. The compounding effect of this growth means Vietnam's economy will double in size roughly every 10 years if these rates hold. In nominal GDP USD terms, the rapid growth translates into Vietnam climbing the regional rankings. In 2023, Vietnam's GDP was about $433 billion, slightly behind the Philippines, $437 billion, and well behind Thailand, $515 billion. But Vietnam is closing the gap fast. IMF data indicate that by 2025, Vietnam will reach approximately $490 billion. And by 2028, Vietnam's GDP, around $589 billion, will be nearly on par with Thailand's, around $593 billion. And soon after, Vietnam is expected to surpass Thailand. CEBR anticipates Vietnam will officially overtake Thailand's economy after 2028. This would be a historic shift. Thailand has long been Southeast Asia's second largest economy, after Indonesia. But by 2029, Vietnam would push Thailand down to fourth place in the region. Looking further ahead, Vietnam is projected to continue its lead against Thailand, but it would not overtake the Philippines. By 2034, CEBR projects that Vietnam's GDP will come close to the Philippines, but not surpass it. In this scenario, however, Vietnam's output would exceed that of several mid-sized advanced economies. To better understand how Vietnam is outperforming Thailand, it helps to compare some fundamental indicators. Below is a snapshot of key metrics. A few points jump out from these comparisons, and the first is their population and demographics. The Philippines has the largest population, 112 million, and youngest population, median age approximately 25, of the three, giving it a long-term demographic advantage in terms of a growing workforce. Vietnam, 100 million, median age approximately 33, also enjoys a demographic dividend for now, but its population is aging faster. Vietnam will hit the point in 2035 where senior citizens outnumber children far earlier than the Philippines. Thailand, 70 million, median age approximately 40, is already an aging society. It crossed that threshold in 2015. This means Thailand's workforce is growing slowly or even shrinking, while Vietnam's is peaking, and the Philippines is still rapidly expanding. A youthful population can boost growth, but only if there are jobs and education to productively employ that workforce. The second is economic size and GDP per capita. Thailand's economy is currently the largest of the three, about $515 billion in 2023. But Vietnam, $434 billion, and the Philippines, $437 billion, are not far behind. In fact, Vietnam and the Philippines are almost neck and neck now in GDP, a dramatic change from a decade ago when the Thai economy was more than double either of them. Thailand still has, by far, the highest GDP per capita, roughly $7,300, reflecting its more advanced development. Vietnam's GDP per capita, $4,300, just surpassed the Philippines, $3,900, in recent years. In short, Vietnam has managed to generate almost the same total output as the Philippines with a smaller population, implying higher average productivity or value added per person than the Philippines, though still well below Thailand's level. There's also the recent growth rates to take into consideration. Vietnam and the Philippines have both been growing much faster than Thailand. In 2023, Vietnam grew an estimated 5.0%, and the Philippines 5.5%, while Thailand grew only 1.9%. Thailand's economy has struggled with slow growth for much of the past decade. Even before COVID-19, Thailand saw only approximately 3% average growth in the 2010s. The Philippines and Vietnam, by contrast, were among the world's growth leaders pre-pandemic, both often achieving 6 to 7% annual growth, and after a brief COVID dip, they rebounded strongly in 2021 to 2022. Higher growth compounds over time to dramatically close the gap with a slower-growing country, which is exactly what we see happening. Fourthly, Vietnam's economy is extraordinarily trade-oriented. Its exports of goods and services are equal to 87% of GDP, one of the highest ratios in the world, second only to Singapore in Southeast Asia. Vietnam has effectively become a major export manufacturing hub, electronics, machinery, apparel, etc., integrated into global supply chains. Thailand is also quite export-oriented. Exports approximately 65% of GDP, with strong industries in electronics, automobiles and agriculture, plus significant tourism exports, services. The Philippines, however, is relatively inward-focused. Its exports are only about 27% of GDP, one of the lowest share among big ASEAN economies. The Philippine economy relies more on domestic consumption, fueled in part by remittances from millions of overseas Filipino workers, and on service exports like business process outsourcing, call centers, IT services. Vietnam's high export ratio indicates a competitive manufacturing sector driving growth, whereas the Philippines' low export share points to underdeveloped industrial capacity. In the long run, Vietnam's export-led model has delivered faster growth and technology transfer. Notably, Vietnam's merchandise exports reached $371 billion in 2022, eclipsing Thailand's $287 billion and dwarfing the Philippines' $79 billion. Lastly, one key reason Vietnam's exports have boomed is its ability to attract foreign direct investment. Global manufacturers, from Samsung and LG to Nike and Intel, have poured capital into Vietnam to set up factories. In 2023, Vietnam drew about $18.5 billion in net FDI inflows, roughly 4.3% of GDP, the highest in Southeast Asia. Thailand, by contrast, saw only $3.1 billion in FDI net inflow in 2023, a shockingly low 0.6% of GDP, following an outflow in 2020 and a drop in 2022. The Philippines received around $8.9 billion in 2023, approximately 2% of GDP. Better than Thailand, but still less than half of Vietnam's haul. Over the last decade, Vietnam has consistently led these three in attracting investment. It now hosts massive FDI-funded industrial parks producing electronics, garments, vehicles, and more for export. High FDI reflects Vietnam's openness to business, relatively investor-friendly policies, a stable political environment, cheap but skilled labor, and extensive trade agreements. Thailand has struggled to attract new FDI outside of its traditional auto sector, partly due to political instability and an aging workforce, while the Philippines historically had restrictive investment rules, such as limits on foreign ownership, some of which have only recently been liberalized, and infrastructure challenges that made investors hesitant. Vietnam's clear edge in FDI is a major differentiator, fueling its growth trajectory. But anyway, do let us know what you think. Thanks for watching.